And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is David McAdams, who's the founder and CEO of McAdams Group with approximately 240 million in AUM. He's also a partner at another firm that manages a few billion dollars. So, David, thank you so much for taking the time and welcome to the Smart Money Circle.
Hey, thanks for having me. I appreciate it.
So, David, I always like to begin. Can you please tell us your background and how you got to where you are today?
Sure, sure. I'm a recovering CPA. Started off out of school at a CPA firm for a few years, and I was helping all of my friends and family, and other people knew I had an interest in investment. I was kind of an uncompensated financial advisor for several years, and at some point, I got tired of the public accounting world. I always knew I wanted to work with people and help others. And so I got into this industry around the age of 25, fumbled around for a few years until I figured it out. And then we really just started focusing on being great at one area. Once I got the focus down, we started growing. And probably for the last 25 years now, have really focused in working with retirees and pre-retirees in a very holistic overall uh, model.
Oh, very nice. So, I know you have a few businesses. Can you please tell us about the McAdams Group and everything else you have going on?
Yeah, McAdams Group, in order to do the fulfillment on our holistic model, we're in an industry where there's a lot of well-meaning advisors, and sometimes they kind of verbalize that they do tax planning and estate planning and other things. But when you survey actual consumers, most consumers will say that they primarily just kind of oversee my investments. So we wanted to be a little different. We want to actually, you know, whatever we're verbalizing we can do on the client journey, we want to actually be able to execute in a holistic fashion. So in order to do that, we have four subsidiaries. We have McAdams Estate Group, we have McAdams Tax Group, McAdams Investment Advisory Group, and McAdams Insurance Group. So in order to accomplish actually advising people in all five areas, we wanted to have the model to actually successfully implement that during the client journey.
I love that. So you started off as a CPA and then you realized, hey, it's a better fit for you to be in the financial advisory side. It was more of a calling for you. You went over there and you realized, hey, there's a holistic style, not just money management from an RIA standpoint or a brokerage standpoint. Let's look at the whole entire holistic investing for the client and provide services for each one of those, from insurance to wealth, estate planning, so on and so forth. Is that a good summary?
Yeah, it's a good summary. In fact, I'll tell you on a more granular level, what actually happened was when I started working with retirees, I kind of came from that typical background where at the age of 25, when I got in the industry, it was 1995 at the time. The stock market was going bananas, as you might know. And like so many people in our industry, the management and the messaging from a lot of supervisors is, hey, you really should put all of your clients' money in the stock market. It was almost like this disconnect of, if you're working with a 70-year-old widow with no investment experience that might be a conservative, safety-minded investor, hey, don't worry about that. You should put it all in the stock market. That's where they're going to make the most money. And what I kind of found in working with retirees, they were more interested in protecting and keeping what they had than just trying to hit home runs. And just by listening and learning, I sort of observed and experienced this huge disconnect. Retirees, they have everything's different. If you're working with a 25 or a 40-year-old versus a retiree, I mean, their health is different. The way they look at risk is different. Their tax situation is different. All of the planning needs are very unique and specific to that stage of life. And what I started noticing was that people were not getting advice in all these areas. I'd find with every client I would meet, I would find asset titling problems, beneficiary mistakes, probate issues, paying unnecessary taxes, not understanding. We have a category we identify in our onboarding process called unnecessary fees. So we're just seeing all these problems rampant. And when I would work with a client during their first interview, I would usually find about 10 to 15 major issues. And there was just a lot of common things that we'd see over and over and over. So what I decided to do was I said, I want to become an expert and how to solve and fix all these problems. And I want to differentiate myself by being the advisor that asks about these things and actually cares enough to take the time to solve those and fix those. You see, a lot of these areas we don't get paid for. You know, in I don't want to say this in a blanket statement. There are many, many incredible advisors all over the country. They have a holistic approach. They're doing everything right. But we do have a segment of our industry that verbalizes that they do tax planning or do estate planning. What they really mean is they kind of farm that out or send you to someone down the street. Where we wanted to be different was we wanted to actually know how to identify these problems, communicate that to the client with how to fix it, whether we're getting compensated on it or not. We wanted to have a checklist, if you will, that by the end of the client journey, we've done our job, we've done everything we can do to identify and solve these issues. I might not be able to actually go to the bank and retitle their bank account, but I can tell them, go to the bank and do this. So that's one of the things I kind of experienced in my 5 years of bouncing around, jack of all trades and master of none. And I finally decided to focus me and become an expert in this area, in this stage of life. That's when our firm just really started taking off.
Gotcha. That makes perfect sense. So let's talk about your investment strategy. What is that? Or please shed some light on that and let us know how
Yeah,
you
I'd say this is also a major differentiator. What we're up against probably 85% of the time, and I think most of your audience would agree with this. You interview a lot of people that have some type of differentiator. They might have some kind of market timing overlay or some kind of, risk adjusted, thing where they're rebalancing in certain areas. What we're really up against in the industry, probably 80, maybe even 90% of the time or higher, is what we would call the more classic cookie cutter approach. Most people have gone to a firm where they've taken some type of risk assessment. They got a score, and gee, Bob and Mary, you're 32. Your score was 32, and at your age, that makes you moderate. Gee, that means you need to put 60% in the stock funds and 40% in the bond funds. The problem with this model is, in industry terms, we talk about sequence of distribution risk. That's something that most of your industry people will understand. Consumers, they don't know what that means. We give simple explanations. We call it the reverse of dollar cost averaging. In other words, if the market's going down and your portfolio is not generating any true income, how are you going to get money in your bank account for your portfolio? I'll give you a great example. Let's take a 65-year-old couple. They have $1 million. They need 5%, $50,000 to supplement their pension and Social Security. Well, it sounds simple. A lot of people bank on growth. They bank on that 4% rule. Hey, if you have enough money in stocks and stocks are going up, gee, if you make 10%, you take out 5, you'll be okay. All right. I don't know about you, but I've been doing this for 30 years. Does the stock market go 10, 10, 10, 10, 10,
Nope.
or is it volatile? All right.
Right.
So if you're sitting there and you're retired and it's 1999 and you have $1 million and you need $50,000, what a lot of cookie cutter models say is they say, great, what's your checking account number? We can just send that to you every month. Yeah, it's about $4,000 a month. Where would you like us to send it? There's very little income planning done in many cookie cutter models. What they're relying on is growth. So the total return of your portfolio is comprised of two components. It's comprised of income, which is the interest and dividends, and it's comprised of growth. What if the G part of the formula is minus 20% that year? Where are you going to get your income? Or let's say you're taking required distributions and they're forcing you to take money out of your IRAs or 401k plans, and you had a minus 20 that year in your stock portfolio. Where are you going to get the money to satisfy that withdrawal? So, in other words, this is not income. This is what is called the withdrawal method, or we call it the liquidation method. A classic example would be someone that retired in 1999 or 2007 would be another good example, where you start with $1 million. Your well-meaning advisor is sending you $50,000 a year, but every month, every quarter, every year for 2 or 3 years, your portfolio is going down, down, down. So what's happening is you're selling more shares to get the same dollar. You're cannibalizing the shares. And so catastrophically, a lot of people that did that in 1999, 3 years later, you would think they took out $50,000 a year. That's $150,000. A lot of portfolios, that $1 million is $380,000. You might say, wait, if the market dropped 50%, how are they down 65, 70%? Well, the reason is every month, every year, they were selling more and more shares. That had a compounding effect. So as they sold more and more shares to get that dollar amount, they wake up with actual less principal. Now, if you're sitting there and it's 2003 and you need $50,000 a year on $380,000 and you live 20 years past that, good luck. You're probably on track to run out of money. So you asked me about our investment philosophies. Our investment philosophies are all about generating true income. We differentiate ourselves by by balancing risk with high interest and dividends. So we call it bucket one, bucket two, bucket three. Bucket one, bucket two would be the more conservative universe. There's an entire universe of income generating investments that, generally speaking, have less risk and volatility than stocks, but generate a lot more income. I will give you a for instance. Some of our income models, the current yield as we sit here on this recording, a typical bond mutual fund might be paying about a 3.5% yield. So if you just told Vanguard or Fidelity, just send me the interest only for my bond fund, maybe 3.5% or $35,000 on $1 million. Our income portfolios are ranging between 6.2 and 7.2% without a big difference in risk. So that would be $62,000 to $72,000 of income on that same $1 million. You could actually put a lot of money in your bank account without having to cannibalize or sell one share of one investment. Our high dividend common stock portfolio is currently just under 4.7%. So it's $47,000 of income versus $15,000 on the S&P 500, with significantly less risk and volatility, I might add. So interestingly enough, when you work with retirees, so many people think their job is to just try to put as much money in the stock market and get as much growth. But what I found is with most retirees saying, "Hey, I would gladly give up some upside potential in exchange for more safety." LIMRA did a study years ago that said 70% of seniors would gladly give up upside potential in exchange for less risk and more safety. So what we do is we take that serious. We actually listen. Yes, we have the capital appreciation of portfolios. We have the portfolios that have Mag 7 type stuff in it. But in working with our clients and taking them through our extensive education process, we find that they typically don't select those type of categories in our consultative approach. It's a collaborative approach where we work together to get to their solutions. What we find is they generally want higher income, less risk. But obviously, people are people. Everybody's situation is different. So we have the ability to customize all those portfolios. All of our models are customized to that individual approach. So not everybody has the same amount of individual corporate bonds or individual preferred stocks or individual real estate investment trusts. That's another area where we're real outliers in the industry. We use individual securities. We don't just believe in pushing everything into ETFs or mutual funds. We're using individual names to drive the results. So it's a lot more work. And we have this concept where we talk about the disease of ease. Do you know how hard it is for a financial advisor to put a client in a mutual fund? If I have my whiteboard behind me and I draw a box and I just check the box, we're done. You're allocated. We put you in this mutual fund. What we're doing is a lot harder, takes a lot of research. We're actively managing those portfolios to drive the results. As in doing so, when you compare our high income models to say bond mutual funds, we've just been able to crush the performance of the cookie cutter models while driving 2 to 3 times more income into our clients' bank accounts.
No, that's a very good way of explaining all that. Thank you. So what you're looking for is that higher income, less risk, meaning you want help people generate income, especially when they need it most in retirement, without having the big drawdowns that come without thinking about when you need the income with the portfolio that's going down in inevitable bear markets and corrections and pullbacks along the way. So what you're doing, if I understand you correctly, is that you're customizing portfolios based on the client's needs. And then you do the work, not the disease of ease. You don't just take the path of least resistance. You're actually doing the work and finding out good ways of creating portfolios that meet the client's needs, give them income. If they want that appreciation, great. But most people you find want the return of capital. It was more important than the return on the capital. So I love that. Let's talk about risk. David, how do you handle risk? You mentioned risk multiple times. And what are some mistakes you see people make with respect to risk management?
I would say, answering the back part of that question first, the biggest mistake people make is, and this is again, I don't mean to disparage others. There's some phenomenal people in our industry, but there are some models out there where I think they sell the greed and not the need. They'll use Monte Carlo simulations. They'll simply plug in a Morningstar portfolio and say, hey, this portfolio over the last 10 years did better than the one you're in. Let's move you over to this one and get you out of the other advisor's portfolio. That's a very dangerous way to approach investing. We call that rear view investing. Again, you probably have the head knowledge to know this, but most consumers wouldn't. If you were to go back to 1999 and look at all the 5-star mutual funds, a lot of those were 1-star mutual funds 3 years later. In other words, some of the top performers in that great market cycle from 1995 to 2000, some of the top performers were down literally 80-90% over the next 3 years. That's catastrophic. $1 million would have dropped to $100,000 and be virtually unrecoverable from that point, especially if you were taking money out. So I think one of the biggest mistakes people make in terms of risk is when it comes to income planning, they tend to be yield chasers. So in the worlds of, say, a real estate investment trust or a business development corporation, they might see a BDC that's paying a 15% dividend yield. I'd say that sounds great. But if we're evaluating that and we're projecting a dividend cut, that means the stock price is probably going to drop 30% just on the announcement. So we call that yield chasing. You're probably familiar with something called a value trap. So we really understand on the risk side how to do a deep dive. On the chartered financial analyst side, we have some very talented CFAs on the team that have amazing award-winning portfolios. I will give you for instance, addressing risk, your question about risk. In 2022, the S&P 500 was down about 18%. I think the NASDAQ finished down about 25% in 2022. Our high dividend common stock portfolio was up 3.6% on the total return basis. So watching out for value traps, not just chasing yield, but actually understanding how is this company generating income? How does my client get a check in their bank account? The other thing that we do to address risk very simply is we have a very consultative approach with our clients. We sit down with all new clients and we take them through an educational one-on-one meeting. We actually sit down and take the time to explain the universe of non-stock market income generating investments, including insured and uninsured options. We talk about advantages, disadvantages, tax implications. Some strategies don't have a fee. There's literally no fee involved. Others might have a management fee. We want to get granular on how that works. There's 5 insured categories and everything else is uninsured. After we've educated them on all of those categories, we collaborate together to determine how much risk they want to take in each bucket. We might talk through it. We might agree or disagree. We might do a little steering. to get to that final result. But at the end of the day, we don't actually implement anything unless we agree and they agree that the allocation is, number one, potentially better than what they're already doing, right? We don't want to make changes for the sake of changes, but also we just want to help them get to their goal. And everybody's different, which is why we customize the approach. By addressing risk, by educating it and talking through each category, you've got a much better chance of getting them to their goal. And also through review process, 30-day check-ins, annual reviews, our client review process, we're always assessing and reassessing risk. We can always pivot and make adjustments to that. But it's so important up front to have that big education conversation. So if I get hit by a bus tomorrow, our clients know 90% more than the average person does, just about the basic categories, advantages, disadvantages, etc.
Yeah, no, that's really powerful. So this way, when things change, because things do change in the market, they're prepared. They're not caught off guard because they're educated. It's another one of those. Like we've seen that before. I love that. All right, David, switching the conversation a little bit to some timeless advice. Let's talk about some timeless lessons that you've learned that you'd like to share with the audience, please.
Timeless advice. Well, the first piece of advice that I would tell my own parents, I would say right now, um, my personal experience is I've been blessed enough in this career to have met many, many advisors that deeply love and care about their clients. They put their clients first. They take the fiduciary title very seriously, and they really care and they want to help all their clients get it right. I would say that's true of most people. At the end of the day, not all advisors have the same head knowledge, the same licensing, the same certifications. They might want to help their clients with tax strategies. They might not know how to do that. They might want to help them with estate planning, but they might not know the difference in a will or a trust or sub-trust planning, asset protection planning, irrevocable trust, or whatever. The first thing I would tell my own parents is make sure, number one, you're working with a fiduciary. Number two, make sure they're an income specialist and that they really focus. If your needs are income, make sure you're working with income specialists. Make sure that they're holistic and that they understand the 5 key areas of a holistic plan inside and out, and that they can actually advise you in all 5 areas. It's different to be a well-meaning advisor, and it's another thing to actually know and care enough to take the time to advise you in all 5 areas to get it right. So you need a holistic planner. That's timeless advice.
What is the what are the 5 areas, please, to repeat for the audience, just to make sure they're clear on that?
So the first thing is risk optimization, getting the risk score right. Also income planning, income optimization from all different sources of income, future unforeseen healthcare risks, estate planning, and strategic tax planning.
Love it. Okay, let's talk about the other side of the timeless lessons. Let's talk about timeless mistakes. What are some timeless mistakes either you've made, you've seen other people make, and how do you avoid them?
I'd say the first mistake I made in my career was just basically for the first 5 years buying into what the industry teaches a lot of young advisors, which is, you know, in terms of process, just this fundamental belief that everyone should have all their money in the stock market, regardless of how they feel about risk. I think that there's a well-meaning, there's something there behind that where you believe that the market's going to outperform over time. So you believe that that's the right thing to do, maybe. But what I've experienced in 30 years is that markets go up and down, and that can be catastrophic. Fortunately, I learned that at a very young age before the 2000 market crash. But I think mistakes I made early on in my career were buying into that people needed to have most of their money in the stock market. Now, fortunately for me, I didn't have a lot of retired clients when I was 25 years old and getting in the industry. But by the age of 30, I'd learned that lesson, and that happened to be around the year 2000. So when the first crash hit, most of my clients had very little, if any, money in the market. PE ratios at 40 times earnings. It didn't make a lot of sense to be invested at that point. So that's a timeless lesson. Mistakes that not only I've made, but I've seen consumers make is buying high and selling low. You know, we've watched this incredible market climb. We're at near all-time highs as we take this recording. But even you have firms like Goldman Sachs saying, "Hey, we might be going into another lost decade." They're projecting an average return of 3% over the next 10 years. They're projecting a negative 1 to 6% range, depending on timing issues. It reminds me of a great article Warren Buffett was quoted in 1999 saying, "Hey, people have to reset their expectations on equities over the next 10 years." He was actually saying at the time, Adam, you'd be doing great if you average 4% over the next 10 years. And people at the time were thinking the stocks just go up 25% every time I turn around. Well, factually, 10 years later, the S&P was down 25%, not up 50. So I think lessons learned. Um, Diversification is talked about a lot, but you cannot chase the growth. And if you cannot afford to take that risk and you're in your 60s and 70s and 80s and you cannot afford a 30, 40, 50% down drop, you really need to address risk. The problem with that and mistakes that most people make, to answer your question, is the way they solve the risk problem. Your typical way that risk is addressed is they either move to cash or they move to bond mutual funds. And that's not necessarily the best way to address risk. You still get into lower yields, inflation concerns, you get into cannibalizing principal. That is a huge mistake also. So taking too much risk when you can't afford to, and not understanding how to de-risk the portfolio while generating true income so you're not cannibalizing principal.
No, it makes perfect sense. And then final question for you, David, what is the best piece of advice you'd like to give the audience or your 30-year-old self?
I would say the best piece of advice I would give the audience is if you are structured right now where you're either currently retired or close to retirement, what you've done in the past does not necessarily mean that that's what you should be doing at this stage of life. It is even Warren Buffett says for his grandchildren, if they're in their 20s, he would tell them to put blinders on, invest in the S&P 500, dollar cost average, and around the age of 55, take the blinders off and start reducing risk. And my advice to anyone is if you're in that stage of life, you need to understand how to generate true income instead of just using cash or bond funds and spending down principal. So that's the advice I would have is you owe it to yourself and your family to get educated and get informed and understand the difference in the withdrawal method versus income. Understand what income is versus just taking money out of your statements. If your advisor is sending you $4,000 or $5,000 a month, where is that coming from? Is it coming from the principal or is it coming from interest and dividends? Understand that, get that right, and you have a much better chance in not outliving your money and also having enough income. And if you're doing it the right way, growing the income over your retirement to account for inflation. That would be my number one piece of advice.
Love it. Well, David, thank you so much for coming on the show. Hopefully we'll have you on again soon.
All right. Thanks for having me. Appreciate it.